For successful business owners, the corporation acts like a vault. The capital generated inside is highly protected, but extracting those retained earnings triggers a formidable wall of personal dividend taxes. Accountants and advisors spend their careers engineering pathways to move that corporate capital into personal hands efficiently. Search online for solutions, and you will inevitably hit a widely circulated strategy: taking a personally owned life insurance policy, selling it to your corporation at its fair market value, and walking away with a tax-free cash payout. There is only one problem. The Department of Finance killed this strategy on March 21, 2016, yet search results and outdated forums continue to promote it. Executing this maneuver today triggers an immediate six-figure tax inclusion on your personal return, alongside severe shareholder benefit penalties under Subsection 15(1) of the Income Tax Act. To see why this happens, we need to trace the precise mechanics of the original loophole, how the government rewrote the legislation to close it, and the mathematical trap waiting for anyone who tries it now. In the realm of corporate tax planning, relying on historical workarounds without verifying current legislative mechanics carries a high probability of structural failure. The architecture of the original strategy relied on a specific anomaly in how life insurance policies are valued. A permanent policy carries two entirely separate valuations. First is the cash surrender value, or CSV, the liquid cash you get if you cancel the contract today, typically quite low. Second is the fair market value, the hypothetical price a third-party buyer would pay to acquire the policy. Usually, these numbers track relatively close to one another, but if the insured person suffers a severe decline in health after the policy is issued, the metrics violently diverge. Because the insured's life expectancy has troughed, the guaranteed tax-free death benefit is statistically much closer to paying out. To an outside buyer, that contract is suddenly incredibly valuable, even if the internal cash surrender value hasn't moved an inch. This divergence, a near-zero CSV paired with a massive fair market value, created a structural asymmetry. Tax planners recognized that this pressure differential could be used as a conduit to siphon cash out of a corporation. To calculate the tax on a policy transfer, the Income Tax Act requires a third metric, the adjusted cost basis, or ACB, which represents the tax-paid cost of the policy's savings accumulation. Consider a business owner whose health has severely declined. As you can see in this ledger, they hold a personal life insurance policy with a cash surrender value of $5,000 and an adjusted cost basis of $5,000. But an actuary evaluates the fair market value at $200,000. The shareholder draws up an agreement to transfer ownership of this personal policy to their own corporation, in exchange for $200,000 in corporate cash. Under the pre-2016 rules of Subsection 148(7), non-arm's-length transfers had a strict reporting requirement. For tax purposes, the proceeds of disposition were legally deemed to be equal to the policy's value, which the statute defined explicitly as the cash surrender value. The actual cash paid was entirely ignored. When calculating the taxable policy gain under Subsection 148(1), you take the deemed proceeds of $5,000, subtract the $5,000 ACB, and the result is exactly zero. On the corporate side, the company paid exactly $200,000 for an asset objectively worth $200,000. Because there was no overpayment, the shareholder avoided triggering a taxable benefit penalty. By legally decoupling the mandatory tax reporting value from the actual cash exchanged, the shareholder successfully extracted $200,000 of corporate surplus completely tax-free. Accounting and advisory firms across the country once utilized this as a cornerstone of corporate tax planning. The Canada Revenue Agency was fully aware of the asymmetry allowing these tax-free surplus strips. In a May 2002 technical interpretation evaluating this exact scenario, the CRA stated plainly that the shareholder was effectively receiving a tax-free distribution, noting it was not clear that the above result is intended in terms of tax policy. But the agency's hands were tied. Because the Income Tax Act explicitly anchored the deemed proceeds to the cash surrender value, auditors could not legally challenge the math, even though it clearly violated the spirit of the legislation. In that same 2002 release, the CRA confirmed they had flagged the anomaly directly to the Department of Finance for a legislative review. The government allowed the loophole to remain open for another 14 years. That long delay produced a massive backlog of literature validating the strategy, which is exactly as presenting it as fact. the window slammed shut on March 21, 2016. The Department of Finance enacted structural changes to life insurance taxation, targeting the non-arm's length transfer rules. They completely rewrote Subsection 148(7) to force the tax values into alignment with economic reality. The drafting team inserted a crucial new variable into the statute, the consideration given, meaning the actual cash or value exchanged between the transferor and the transferee. Under the post-2016 rules, proceeds of disposition are no longer tied exclusively to the CSV. The new formula legally deems proceeds to be the greatest of three numbers: cash surrender value, adjusted cost basis, or the fair market value of the consideration paid. This specific phrasing acts as a mathematical ratchet. It ensures the mandatory tax reporting value is forced upward to capture every dollar of actual cash being pulled out of the corporate account. With a single legislative sentence, the government completely inverted the mechanics, turning the strategy into a tax generation trap. To see the damage, we can run the exact same transaction through the modern statute. The impaired shareholder transfers their personal policy to the corporation and extracts their $200,000 in cash. The variables remain identical. Cash surrender value is $5,000. Adjusted cost basis is $5,000. Actual consideration paid is $200,000. Applying the modernized rule, the formula evaluates the inputs and selects the greatest. It discards the low CSV and isolates the $200,000 consideration. The Canada Revenue Agency now legally deems the proceeds of this transfer to be the full $200,000. We execute the final tax calculation under Subsection 148(1). The $200,000 in deemed proceeds minus the $5,000 adjusted cost basis generates a taxable policy gain of $195,000. This is not a capital gain. The shareholder must report that entire $195,000 as fully taxable ordinary income on their personal T1 tax return in the exact year they made the transfer. Relying on this outdated online advice causes the shareholder to report the entire extraction as personal income taxed at the highest marginal rate. The modern legislative landscape demands precision. The structural location of a life insurance policy, whether it is owned personally or corporately, must be strategically mapped out before the contract is issued. Pivoting ownership later in life triggers a taxable disposition under current rules, regardless of the owner's intent. When researching tax strategies online, rigorously verify publication dates. If an article discusses fair market value transfers and was published before March 2016, it represents a severe financial hazard. Before executing any transfer of an existing policy between a shareholder and a corporation, have a specialized tax accountant or insurance actuary stress test the disposition mechanics under Subsection 148(7). If this breakdown helped clarify your corporate planning, please like the video, subscribe to the channel, and share this with your advisory team or fellow business owners to keep them out of this trap. Next time, we will explore one of the most powerful and misunderstood mechanisms in Canadian corporate tax, the capital dividend account. We'll see you in Episode 9.